Hi, I'm Michael Hass with Live a Better Retirement Lifestyle. Today's video is titled Retirement Rollovers Explained Part 1. A rollover is simply the movement of money from one retirement savings plan to another. You may want to make a rollover for any number of reasons. Perhaps maybe you just recently changed employers, or you might have received death benefits from your spouse's retirement plan, or perhaps maybe you just recently retired. There are two different kinds of rollovers. There is the indirect rollover, which can take up to 60 days to complete. And then there's a direct rollover, which is a trustee-to-trustee transfer. With the indirect rollover, you actually receive a distribution from your retirement savings plan. Then to complete that transaction, you deposit those funds into your new retirement savings plan or your IRA account. You can make a rollover at any age, but there are some specific rules that must be followed. For instance, you must complete that transaction within 60 days from the date the funds are paid out of your distribution plan. Properly completed, the rollovers are not subject to income tax, but if you fail to complete those rollovers within the 60-day time frame, your distribution may be taxed and subject to the 10% penalty unless, of course, you reach age 59 and a half. And keep in mind that if you do receive a distribution from an employer plan, that employer must withhold 20% for the payment of taxes. So that means if you want to roll over the entire amount and avoid the taxes and possible penalties, you must come up with the 20% from other funds. You can, however, recover those funds when you file for your taxes the following year. Now, with a direct rollover, this is actually a transfer from the trustee or custodian of your old retirement savings plan or to the trustee or custodian of your new retirement savings plan or your IRA account. Because you never actually have control of the funds, the direct rollovers are not treated as a distribution, and therefore you cannot miss the 60-day deadline, nor is any 20% withholding problem to deal with. Now keep in mind, if you receive a distribution from your employer plan that qualifies for a rollover, your employer must give you the option of either rolling that over to a new 401k plan or your IRA account. And of course, the most efficient way to move retirement funds is the trustee-to-trustee transfer. So the question is, should you consider a rollover? Well, if your vested balance is $5,000 or more, you can keep that money in your employer's plan at least until you reach the plan's normal retirement age, which typically is age 65. But if you terminate employment before then, do you roll it over to a new employer plan or your IRA account? Okay. So the first option, of course, is to leave the savings in your former employer's plan. Pros and cons to both. Okay. So we'll just say as good as the 401k is, because of the pre-tax contribution and then for the match, you can't make any future contributions, and therefore there's going to be no match from the employer, obviously. So there's a couple of benefits you lose by leaving the money in the former employer's plan. Then there's the second option, by transferring the assets to your new employer's plan, that is if they allow those rollovers. Okay. Some of the pros of doing that are your new qualified employer plan has unlimited protection from creditors, regardless of whether bankruptcy is declared or not. Then there's also the Rule of 55, which simply states that if you leave your job, whether you're laid off or retired, during or after the year you reach age 55, you can actually tap your employer-sponsored retirement savings plan without that 10% penalty. And it's important to note that this applies to the current 401k plan that you just left the employer, okay, the one you just left. But you cannot tap any old 401k plans from previous employers. And if you attempt to do that, the 10% penalty will apply if you attempt to do that, unless, of course, you reach age 59 and a half. Some of the cons of doing this could be, as good as the 401k and the 403b and the 457 plan are, because of the pre-tax contributions that lowers that tax, and for the match, free money, crazy not to take it. As good as they are, I call them the cafeteria plan. And why I say that is, you may invest in the 20 or 30 investment options that are laid out for you, with nothing else to choose from. Plus, you typically don't get to work with a personal investment advisor, okay, who could proactively manage your funds for it. Now, it's true that you can call somebody up from your 401k or your 403b or your 457 plan. You can call them up and ask them questions about the plan and your account specifically, and you'll get your questions answered. But nobody's going to proactively contact you from time to time to make suggestions the way a personal investment advisor does. The third option, of course, is to take the distribution in cash. And keep in mind that anytime you take a cash distribution, it does result in a taxable event and may be subject to that 10% penalty unless you reach age 59 and a half. So these are the first 3 of 4 options for rollovers when you change employers. Watch our next video to see the fourth option, which is going to be rolling your 401k, your 403b, or your 457 plan to your IRA account. So watch the next video coming up with that, part 2. If you got any questions about any of this material, or in the next video, and you want to schedule a consultation or a Zoom meeting if you desire, click on the button below labeled Let's Talk, and you can schedule that phone consultation or Zoom meeting, and look forward to speaking with you.